Welcome to Nothing Exempt. I am Nick Pardini, and I'm with my co-host Brian Piotr, and we have a special guest, Tony Greer, who's the editor of TG Macro. He is also the guy who interviewed me on my Real Vision appearance back in December. The thing I want to mention before we get started is Nothing Exempt kind of has gone off into a lot of various different topics, and we're going to kind of go more into our core, which is like macroeconomics, political philosophy, and financial markets because that's kind of Brian and I's core wheelhouse, and that's what a lot of the audience wants to listen to. And I'm less hesitant to talk about that stuff now. So now with that, let's introduce this conversation. Tony, one of the lessons I've learned from you, and I've been thinking about since we did our interview, is the divergence between fundamental and technical analysis and how to trade and which side to do that. Uh, the thing is, if you look at a lot of what's going on in the market, a lot of my technical indicators and analysis implies that the S&P should be at new all-time highs by the 4th of July and 4,000 or higher by Christmas. But then if you look at just what's going on in the macro economy and involved earnings and other things like that, it implies that the S&P should be 2,000 or less.
Right.
How do you reconcile that type of divergence? And have you seen anything this extreme before?
No, that's a good way to start, Nick. No, even in my 30-year career of sitting in front of the screens and living through two prior crashes before this and several, globe shaking events, no, I've never seen anything as extreme as, the market sell-off that was incurred by the government shutting down the economy due to the coronavirus. So no, this is uncharted territory, I think, literally for everyone involved. So the way I look at it, Nick, is I try to take, I approach it from a totally different angle than you. I'm one of those guys, I guess, on FinTwit calls now stock price bros. You know what I mean? Like I'm a last sale guy, and that has come through the evolution of myself as a proprietary trader, right? Where you look at it as a fundamental investor, and you do your homework and you say the S&P should be this or the S&P should be that. See, I used to do that. I used to, a long time ago, think about what I thought the world should look like and then position things and expect them to sort of work their way back to my Tony Greer's image of the world, the equilibrium, where I was happier where those prices were. And I no longer have that should be in my vernacular, right? I let the market tell me where it's going. I let sentiment tell me where the pain trade is. I let, sort of reactions to optics let me know sort of what people are really thinking about the markets and what they can't even conjure. And so sort of with that approach, you relieve yourself much more. You take a lot of pressure off yourself when you pivot from the S&P or this stock should be priced here to the market's telling me this, and I'm going to surrender to the flow. And I'm going to say, ooh, this is going on here. This is interesting. And it's not up to me to say it should be here or it should be there. It's up to me to say which way is it going and how can I be a part? That's how my evolution of a trader has changed. And I think I probably would have asked and felt I was in the same position as you, at your age in my life, and in my, mid 20s and mid 30s when I got started, like I said, I would look at things and expect them to be someplace because I did so much reading and I thought this or that. But I let markets last sale tell me the direction now. So hopefully that answers your question.
Yeah, I mean, I've tried to take a hybrid approach to it where I choose what I trade based on fundamental views, but then I choose whether to enter it based on technical factors. But it's gotten so detached that even a lot of my normally like reliable like entry signals have kind of broken.
Yeah.
Well,
Yeah.
I want to ask both of you guys, but personally, I think that this market is 50% plus influenced by what people think the Fed is or isn't going to do at this point, and what they're going to buy and what they're going to back and what they're going to bail out. What do the two of you think?
Totally. Totally. I'll just jump in, Brian, because my view, the way that I've been able to latch hold of the S&P and be a little bit of ahead of it rather than behind it, has been saying, what is the market looking to, what is the unthinkable trade first, right? And when we were up at the highs in February, the unthinkable trade was, oh, this coronavirus is going on, but nothing's happening to the markets. The unthinkable happens and it collapses, and then we have the detachment from reality. But the reality is that the Federal Reserve is putting the stop on all of the economic damage. And, nobody is considering the fact that for now, for the foreseeable future, or at least for the market's foreseeable future, it might be working.
Yeah, I mean, I agree, Tony, to a certain degree. The thing that makes it tricky to go long here is when will the markets call the Fed's bluff? Like the ECB and the Bank of Japan have been doing the same, if not been more aggressive on easy policy, but their markets don't care nearly as much. I mean, they move up on a rate decision day, but they don't have the same sort of FOMO that's going on in the U.S. Why do you think, Tony, as a trader who's been around longer than me, that the U.S. has such a stronger reaction to monetary easing and a stronger bullish bias than other countries' financial markets?
Ooh, that's a really good question, Nick. And I think that a little bit of the answer lies in the dynamic here that doesn't exist elsewhere. There was a really interesting dynamic that occurred last fall when the market was sort of climbing that roller coaster hill up from 3,000 to 3,400 in a very low environment, and low vol environment, but it was just chugging higher and higher and higher. But what the dynamic underneath was that there was a record number of accounts opening and at Charles Schwab and Interactive Brokers and E-Trade, and that's continuing to happen now. And we're seeing, we just went to free commissions, so now people can look at the capital that they have and literally just do the math on their trading and say, okay, I can get out of this. This is my risk. There's no extra cost. This is a good deal for me. And so people, I think, to deal with the weakness in the economy, they've taken some of the savings, if they've had any, and pivoted it to working capital and pivoted it into the markets. And so there are actually, I think, a lot of new animal spirit players in the market, even though the economy is on its ass and dealing with this lockdown issue. But I feel like that animal spirits were on a retail level reignited once again, because a lot of my friends in the wealth advisory business are as busy as they've ever been right now, right? Everybody needs an opinion on where the market's going. There's a sort of new community sprouting up, and I feel like there's a new Wall Street sprouting up, right? There's the old wall of the Goldman Sachs and JP Morgans, and then there's a new wall of all kinds of independent analysts that people are anxious to listen to. So go ahead. What do you guys think?
Yeah, I mean, I did this on my performance report. I wrote recently about how retail has been the number one driver, and half of those people are traders under the age of 35.
Yep.
And they're just buying stuff that is what they see as cool or as something that is the quote unquote the future or the technology. I mean, isn't that really just the trade just to buy Bitcoin because that's the most highest beta, least fundamental asset out there?
Yeah. Yeah, it could be. But think about it, Nick. We've created this mindset here in the US with the help of, CNBC, that the market's functioning properly means they're going up, right? The market's functioning improperly means there's a crisis, right? If the markets are going down and repricing, oh my God, that means that there's a crisis going on, right? It never used to be like that. It just used to be, well, stocks are not as in favor today as they were yesterday. But now, if the market goes down 200 S&P points, what's flashing across your screen? Market's in crisis, right? So as long
How
as
much of that is just entitlement from baby boomers who just don't think they deserve to ever take a loss?
Oh, absolutely. It is. But as long as the credibility and the greater fool game continues, where, there's more money coming off the sidelines into the market and it's going higher and people are buying it at higher levels, that's going to continue. But I feel like, to answer, which goes back to your question, is we've got this new class of investors with red-blooded instincts looking to make money, right? We've got the mindset that the market, when functioning properly, always goes up. So these guys can be optimistic about the market, wake up in the morning and say, okay, what can I buy here on the cheap? Right. And a lot of times when you combine that retail flow with a mutual fund that's trying to buy something cheap for his 25-year time horizon, and then you throw in high frequency traders that are going to run both of them up to the moon if they're both buyers. Well, then you create these kind of upside, reverse waterfalls that we see. It's our own fault for allowing this to happen.
Yeah, that's just the other question I have on that is, if you've seen basically since the 1980s, you've never had a tightening cycle that was higher than the last tightening cycle. People that say like there's the radicals like the Peter Schiffs of the world that say that they never tighten. That's not entirely true. It's just more that they've never marginally, like you've never had a higher high if it was a stock chart in terms of Fed monetary policy.
Yep.
And what is to stop them from just perpetually having rates fall deeper and deeper, negative real indefinitely, and just lying about the inflation numbers? As we've seen, for example, like certain like packages at the grocery store, or I run my alternative inflation numbers for my clients, and they're consistently, especially exclude crude oil prices, about 2 to 3% higher than what the market, what the government's CPI and PCE is. Like, couldn't this just be like a USSR thing and just last indefinitely, even as the society devolves into a much poorer country broadly?
Yes, Nick, and this brings back the memory of when the first time that I met you and we came across this conversation and our sort of eyes lit up talking to each other and being, when we both came to the mutual realization that we looked at each other and said, well, neither of us believe CPI or PPI, right? And then we went into this whole thing of what the secondary and tertiary effects were going to be of this invisible inflation. And so, look, man, couldn't we evolve into a USSR or a China type of situation where the data is what the government says it is? We sure can, and I feel like we've been in that situation. I feel like the problem is we can't reverse that situation, right? No matter what, CPI just doesn't seem to budge from 2%. And I understand that there are deflationary forces that counteract inflationary forces, but it sure seems to me like the costs and the forces of exploding education and healthcare are basically in a crisis situation, and there's nothing we can do about that. Meanwhile, there are other deflationary forces that are sort of much less severe, but they're also happening at the same time to sort of balance things out. But I tend to agree with you that real inflation is much, much higher, than official numbers prevail. And I don't know what else to do about it, Nick, except trade the numbers on the tape that the market's reacting to.
So in this crazy world that we live in, how is it possible that these corporations like Boeing are able to get $25 billion in long-term bonds? They can print debt at will. Where's all this money coming from, and who actually believes that a 4.5% rate on 30 years is going to be a good trade?
Oh, man. I mean, Brian, that's a great question. And the answer is so far above my pay grade because I would be pivoting myself right next to you to ask that same question. So I'm afraid I don't have the answer. But, I think that it's along the lines of the credibility that we've built into this market over the last 10 years. It's whatever has seemed to put the sort of, let's call it the high yield market at risk, right? In terms of like where pricing interest rates should be, right? Whenever the high yield market comes at risk, the Fed steps up with some kind of a mechanism and says, no, hang on a second. No. We don't let the high yield markets in the United States go down, just so everybody understands, right? And they make it very clear. And this time around, they literally left the playbook open, flapping in the breeze. We are going to buy all of the corporate credit now. So, like, you've alluded to the fact that, yes, we are turning towards a Japanese type of mechanism where the central bank is the owner of all of these assets. And I think that that's probably the reason that we get to the point of being able to let Boeing borrow money at, 4% over 30 years. You know what I mean? Like, it's just the fact that the market will bear it. The market will bear it. If Mexican high yield can be 4.5%, then why can't Boeing borrow at 3.5%? Like, it's just relative. It becomes all relative.
So then,
can I borrow $1 billion at 5%? I'll do it.
You and me both, man. You and me both. But unfortunately, the game is not stacked that way. We don't have the political clout, and we can't afford to pay lobbyists enough. So we're out of the game right now.
Well, yeah, I mean, the thing is, this is just from a broader macro perspective. I actually was interviewed on another podcast last night talking more about the future of like young people's employment prospects and how to adjust for careers in this case. And it seems like on the low end, with these extended unemployment benefits, you have people under the median getting paid more not to work, and then the very rich are getting bailed out through Fed policy, whether it's there nobody defaulting due to corporates being bought or asset prices being held up indirectly. Like, what at what point does just the middle 40% of the population just pull an Atlas shrugged here?
Oh man, yeah, dude, I'm totally with you on this, and you guys caught me literally just after I read the article about how Eric Schmidt and Google are inserting themselves into the, American biosecurity story. So, we're looking at this post coronavirus thing where now big tech just got stronger, and it's like, you're wondering what's the way out of this. And I'm wondering right alongside you, right? But the only thing that we can do in the markets is make our moves, right? And invest in the things that we think will be the right places to benefit from this. And I'm starting to think that, if you don't have, a significant position in Amazon, Microsoft, Facebook, and Google, that you're going to be significantly left behind in this rally, so, in this recovery. So however it goes, because they seem to be the benefactors. And, on this side of the coronavirus, I don't know what stops that 40% of the middle class from just sliding into the bottom class. I mean, you just saw the data. Look at it on the initial claim side or the non-farm side. Initial claims, 33 million that have applied for unemployment insurance. We're going to have to find homes for all those people and income. And the problem is with big tech being involved with the recovery is that we may not necessarily be going down the road of doing things like expanding our healthcare system with more doctors and et cetera, and create more jobs. It's now going to be, oh, no, 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 you have to take your temperature from home because Google figured out how to do telehealth. And now where's the middle class left? I mean, we're basically left separated at home without a voice and just following all the rules of Big Brother. And it's not a comfortable place for me to be either, but I've made my bets in the market on what will work out under that circumstance. So that's
So,
all I got.
can you argue that basic income would be bullish for markets? Because I think the only way this rally can go, say, above 3,000 on the S&P and stay there is if universal basic income proves to be successful economic policy.
I do feel like, Nick, that is happening whether we like it and believe in it or not. It just seems like, we started this MMT conversation not too long ago in the recent past. And, the UBI is part of that. And it seems like, when I look at the Fed balance sheet and I see it go blasting through 4.2 trill on its way to 7 trill, we're at 6.5 or 6.6. But, I look at that chart and I say, I wonder if there's anything stopping them now, right? Like 4 trillion was the cap for a little while. And I feel like we kind of kicked the Overton window open to where the balance sheet is going to go. And I don't think there's a cap on it right now. So along the lines of what you said is, is universal basic income going to become the thing that keeps the S&P propped up? And my answer would be yes. Because this time around in this crisis response, the Federal Reserve is very, very deliberately handing money out to Main Street, right? They're obviously taking care of all their banking overlords, but money is getting to Main Street in the form of these small business loans and PPP, et cetera. And I think that what will happen if Main Street cries out for more, I think that the government will pivot and say, yeah, this works for us too. There you go. There's more. It's more of a divisive thing. It's more of a class, wealth gap divider, and that's good for the government. So I would imagine that they might be 100% behind this policy. The more dependence, the better, and optically, that might be a good thing for the S&P. I don't know if that's the answer between whether the rally survives or not, but I would agree that that's something that would be, that's just more accommodation. It's bullish.
Well, I think that's all Joe Biden needs to promise to ensure the election. It's just whether he's going to go that far or not is kind of the big question for 2020.
Did
Well,
you say?
I don't disagree with you guys that UBI would prop up the S&P. I think that is not coming in the next few months, and that there are, I don't know how many people with 401ks that are going to pull money out of the 30 million unemployed, maybe 10 million of them are going to have to pull money out of their 401ks, but there's going to be a huge lack of investment coming from those newly unemployed uh, blue collar and white collar workers. That does not speak for pumping Main Street money into the S&P in the next 3 to 6 months.
No, but it feels like we're pretty much held over for the next couple of months. I feel like the problems that we'll face will be a couple of months down the road when the reopening doesn't go as smoothly as planned, and then people still realize that they never had enough cash to get held over. So I feel like that's, well, for me personally, I just feel like that's a sort of maybe a third quarter optics situation.
Yeah, and then the next question I have based on this too is this is just more of a philosophical macro approach. Both of you guys can answer this. Is are we like in the turn of the 20th century, we transitioned from a agricultural society to an industrial society. In the late 20th century, we transferred from an industrial society to a service economy. Now with the coronavirus making people more hesitant to talk to each other in person, along with just the fact that a lot of people's incomes are not viable without face-to-face communication, and the potential production function for like a normal growing economy doesn't need full employment. Are we transitioning from a service economy to a distribution-based economy where basically the amount of stuff that's created in growth is kind of going to happen no matter who's employed or who's running it, and it's just a matter of how to allocate that wealth that's created, and we decide politically who gets to be in what social class.
Deep question, Nick. The advancing stages of the economy. I mean, I like how you put it. How we went from we went from an industrial into a service economy, and looking at it now and saying what's next, and is distribution the next way? But I'm not. I mean, I don't know if that's necessarily the same. I mean, I think politically we probably lean that way. But when I think of it in terms of economy, pure economy, I would rather look at it as we are going toward a sort of it's going to be a security economy is what I think, right? I think it's going to be, and this is, I'm getting from what the market's telegraphing recently, where the economy, everything about the economy is going to be about either sort of biosecurity or firewall security, right? I mean, we're just seeing like these, I think we talked about it on the phone where we thought that, even though there was a disinflation attached certainly to the lockdown of the economy, we both discussed that we thought that there was a highly inflationary second part of this story. And I feel like that's starting to reveal itself now with the sectors of the market that are just literally taking off. And if you notice, they're all subsectors of tech. Right, it's all biosecurity, it's all biotech, it's all cybersecurity, it's all software. Right, so to me, that speaks to the second phase of the reopening of the coronavirus economy is going to be everybody that's working from home now needs a firewall. Everybody that's carrying an iPhone now has to have a vaccination pass on their phone. Everybody that's traveling now has to get a health check-in the night before, right? So I feel like that the next phase of the economy is going to be this excessive layer of, oh man, I forgot to check my health boxes before taking on this task or going on this trip, and so that's kind of how I'm seeing it, a little bit differently than you.
Well, I mean, I could see the market is telling me this. I didn't think that's an interesting alternative because the market is telling me basic income, just given the fact that consumer entertainment stocks that are not in person, such as video games, Netflix, a variety of those are leading the way higher online shopping. So
yeah, I feel like that could be attributed a little bit to those are going to succeed through the lockdown, right? There was no effect on video games in a lockdown other than they exploded with everybody playing them, right? Like, I don't know. I feel like that could be temporary, but I could be wrong. I don't know.
Yeah, and then also that gold and Bitcoin are leading this move too, which implies just a central bank driven like societal bailout versus an actual economic recovery, and then no participation outside of really the U.S.
Yeah.
But the other thing, how like in terms of like we mentioned back to the idea of like transitioning from trading based on fundamentals of price, was there like an aha moment that happened, or is it more of a gradual thing?
It was a lesson you pay for, Nick. It's a lesson I paid for. I can say that I negotiated the .com crash just fairly okay, because of a story, of a separate story that happened sort of in the middle that I don't want to take away from your question. But I navigated the .com crash okay, and I navigated the great financial crisis okay, but I learned a very expensive lesson in the retracement rally, or rather the real rally after the market crashed after the financial crisis, right? I decided that there was a level that the S&P should have reached and shouldn't go beyond given all the damage that had taken place, and probably started buying puts and blowing capital apart in the rally, probably starting by 2010, and I took just an expensive lesson, buying puts and watching the capital wither away and saying, I'm missing something here and I'm not sure what it is yet, and it was finally like when you came out and learned that sort of David Tepper was the first person that the light bulb went on for in 2009 when the Fed came out and said that they were starting QE. The sentiment in the equity market was still so negative and so heavy, and people were still gushing stocks. And David Tepper was like, light bulb went on. Oh, buy everything. I get it. And he was the first one, and that's why Appaloosa's returns coming out of the great financial crisis were ungodly. And so, it's learning that lesson of saying, okay, well, I'm fighting the Fed. It's costing me money. Maybe I should stop. And then pivoting into, okay, I see what they're trying to do here. Let me read the tape and read what the market's telling me. What sectors are responding on what days. And then finally, you get a hand on what the market's trading off of. And it's not trading off of what your vision of the S&P is. That's for sure. So, I mean, meaning mine or yours. So,
Yeah.
yeah, it's. I think that lesson is about discipline. And I think if you get your hand burned on the stove enough, you realize that that's not the way to go.
But then that's the question I've always had is with this pain trade thing. Sentiment analysis is probably not a strength of mine relative to my more fundamental views, and also just I'm decent in terms of technicals as well. Sentiment analysis is something I've gotten more into say the last 3 or so years, and the thing is that it seems like the pain trade is always higher.
Yeah, yeah.
Like no matter what, because people just don't believe it can get more ridiculous. Like hype. So, is there what would cause that to shift? Is the narrative currently? Is it basically going to take a far left political revolution, or is there going to be, or is it just like you're going to have the typical euphoria, which may not happen for a while if you have people permanently unemployed?
Rephrase that question, Nick. I'm not sure what you're asking.
Like, how do you what you're looking at in terms of the market that's going to cause the pain trade to stop being higher?
Okay. All right. So to me, the market since the bottom, the market has been in two very clear, distinct rotations to me. First let's just talk about we had this historic spill. The fastest route to a bull market that we ever saw, the fastest route to down 10%, the fastest route to down 20%, the heaviest selling that the S&P ever encountered, right? It was from late February to late March. Inside there, we had those massive days of selling where the tick index was putting up these unbelievable numbers. It was absolutely historic. So there's got to be an opposite reaction to that in the markets. And if you're ahead of it saying, oh boy, when this freaking thing stops going down, this market is going to go up to a price that is going to have the world throwing eggs at it. And the reason that that is because sentiment flopped so negative at the bottom because people couldn't even get their heads around stock bouncing. And then everything remained negative and stocks just started going up as soon as the accommodation arrived. So I guess the way to say when will it stop first is to identify what rotations the market went into since bottoming. And since bottoming, first we went into a sort of longer lockdown than expected rotation, where energy was getting killed. We had that episode where May futures went negative. To me, that was a generational bottom in the energy markets, right? So you had all these things crushing and weighing on sentiment. And the reality is that the world was ready to reopen, but traders were still mesmerized by this May contract and oil futures going negative. So what happened, we went from this longer lockdown than expected with a unbelievable historic energy moment within it. And then the market started pricing in a reopening, right? Starbucks said 85% of our stores are going to reopen, et cetera, et cetera. Europe reopening, California's reopening. And next thing you know, energy gets going right to the upside. And there's nobody there to stop it because everybody has rolled out the calendar, right? So now we've got all these optics of positive optics of the energy market rallying. And it's like, how are you going to hold the stock market down when energy goes up and when crude oil goes up 10%? And the answer is you're not. Right. So what's going to happen is all of these exuberation trades, maybe or maybe not, will run out of steam on the upside, but they'll run out of steam. And when the rotation changes to, okay, now we're pricing in the reopening of America. And then the rotation will change to the reopening of America has speed bumps, right? This sector's working. This sector's broken. And then we're going to have another extremely volatile period. My anticipation is that's going to be up around 3,000. My anticipation is that's going to lure in a whole new class of retail investors and buyers and traders. And then I think from there, we'll have another situation like we had at 3,400, where everybody's so comfortable with the Federal Reserve being behind this market. But the problem is the boat got off sides and everybody got long. And so then maybe there'll be a pullback from there. But as long as the Federal Reserve is not going to flinch and keep coming with accommodation, I mean, I'm a dip buyer rather than a rally seller. I really am. And I know that the economic hardship is going to set in, but the reality is the economic data is probably not going to get worse than what we're seeing right now.
Yeah, in terms of like the 2019 crash and recovery, where it was almost as fast as this one, that was like the shortest quasi bear market in history prior to that.
Yeah,
Retail, then the Robinhood bros greatly outperformed hedge funds, which made really little to no sense to me back then.
great
Is
point.
is that going to happen this time again?
It feels like that setup almost. You made such a great point where, like, all of a sudden the Robin Hood bros took over, right? And like I felt that from 3,000 to 3,400, right? Last fall when the repo window, they were trading 80 billion at the repo window every day. Like the number was completely insane and the market just ticked higher based on that. So it was very interesting to see that group of people get hold of them, or sort of that mentality get a hold of the market, keep it up longer than it probably should have been kept up as coronavirus sprawled around our country. And all of a sudden, it was, I'm trying to remember what the exact, linchpin was, but then it was all the air out of the balloon at once.
Yeah, I noticed on the way down, Tesla was the last stock to go down, which was
Yep.
kind of telling. And then the other thing is sentiment in terms of positioning versus what people say. Because if you look at like the those AII numbers where it's saying that you have record bearish sentiment still, that the market is recovered like this, and the only times that were like this where you had a big recovery and strong bearish sentiment was right after like say 87 and '09. But at
Mm,
the same time, if you look at actual positioning of dollars, it's not nearly as bearish. Like the net gross exposure, I mean, net exposure for active managers is about the same as it was, except for like in 2015, 2016, 2014, like the Obama administration average, which was mostly a bull market. And
mm,
you see similar things with the futures positioning has improved a little bit. And you also just every call that I get just from the retail types and friends of mine aren't in the market is I want to buy.
yeah.
Like I'm getting random people who don't know about the market sending me emails from Motley Fool saying like, should I just be following Motley Fool? And I never got those in earlier parts of this market, like since 2008. So I mean, I don't really know what to believe when it comes to sentiment indicators. It seems like it's like politics. You can make up any sort of sentiment vision that you want. So, can you like educate our audience about how to actually accurately assess this type of stuff?
Yeah, Nick, that's a great call, man. It's very difficult to read sentiment. Honestly, it took me forever to sort of feel like I had a handle on it. And I think the way that I have a handle on it is, as you point out, finding what your sentiment readers are, right? And to me, that's sort of getting a hold of, whether it's the work of Jason Gefford of Sentiment Trader and learning how he interprets markets, because it's very brilliant. Or you can start with something as simple as reading the CNN fear and greed indicator, because believe it or not, as elementary as that thing is, when you look back at it, that thing was printing 99 at the top at S&P 3400, and it was printing 1 when the S&P ticked below 2200. Right, and I had people calling me up that were wise guys saying, "Hey, what's up? Which S&P 1500 puts do you think we should buy today?" And I was like, "Well, that's the bottom."
I remember I was texting you that same day about selling 1,500 puts.
I think
Which,
you were one of the people I'm talking about, but there was a crowd of them, man. There was a crowd of them, literally all at once. As soon as the S&P got to 2,200, everybody asked me about 1,500, and that's how I knew that there was nobody looking on the upside at all. And then next thing you know, the Fed shows up and they all got fried.
well, that was one of the few. That was one of the best trades that's worked for me this year, was selling those fall. I just thought it was out of control. But who's buying 1,500 puts at 21? I mean,
No, man. I mean, maybe there's some, it's a tough one to call. Maybe there's some people trying to protect a bigger nest egg than we know about, or maybe it's people just punting. It could be literally a wealthy person in Dubai saying, you know what, I'm going to bet 20 million, 30 million bucks on this. You never know, man. You never know.
yeah.
Oh, that brings up an interesting point. How is Forex and foreign money affecting our current market right now with everything going on globally? There's a
Oh,
whole lot less money in the Middle East than there was in January.
very good point. Very good point. The one thing that you learn, I feel like I've observed about Saudi Arabia in particular, is the sort of, the most dangerous animal is the jungle, is the wounded animal, and during the whole time that they were trying to take Saudi Aramco public, you remember reading about how Saudi Arabia needs $70 to break even, and all of this, and they got pretty Machiavellian with their attempt to, pour oil out at under $30 with Russia and, knock the shale business apart. So that's just interesting to me, like speaking about the flows and what the currency markets have done, um, in response to these wacky things that have gone in the interest rate market. And what all I see is like the resurgence of this dollar as wrecking ball kind of thing, where the dollar index doesn't really trade up or trade down too far, but you see these emerging market currencies just coming apart, and we're kind of seeing it now in India, and we're kind of seeing it in Brazil, and a little bit in China, and definitely in Turkey. These currencies are just coming apart, and it's simply because, they don't have the size of the central bank to combat the problems like we do. They're beholden to this weakness in the commodity market, so they can't even get an economic leg up. And so I feel like the FX flows have been sort of very difficult to read. But if you sort of just sit back and use them as a barometer and not as sort of figuring out that that's where you should be taking risk, I think that they can be pretty telling at times. So I'm kind of using FX flows more as signals rather than, where placing my bets should be, if that's fair to say. And I'm
Yeah.
not
What
sure.
about the divergence between the stock and the bond? Sorry, if
No, no,
let
no,
me
not at
finish your
all.
thought first.
No, no, not at all. I wasn't sure if I
All right.
answered this question. Go ahead.
Yeah. So the
Oh,
bond
no,
market
I think
too.
I, I think I think you did answer it. I was mainly curious if you were going to say anything about the euro dollar. Is it going to survive this period of time and be stronger, weaker, dying, whatever at the end of it?
You mean the euro currency in specifically?
Uh, no, the euro dollar system,
Oh,
our
the euro dollar
international,
system.
yeah.
Right. Yeah, I'm not a believer. I don't even engage in the arguments of whether the dollar is going to be a sustainable reserve currency. I really don't. I look at the dollar where it's trading. It's in the middle of the middle of the middle of the middle of the range that it's been in for the last 40 years. And, I don't believe in the fact that I don't think that anybody takes over the US petrodollar until they have much bigger set of aircraft carriers than we have.
Yeah, just also with every central bank probably pursuing some sort of extreme monetary easing, there's no reason to have significant FX volatility, except for
Yeah,
maybe in Australia because
agreed.
they have geopolitical realignment issues. But that's there. So if everybody's going to be playing the same game, there really is no relative value bets on FX out there. The question I have though is with the bond market, like you and the idea of reverse risk parity, which I talked about on our Real Vision interview, which I think has that was starting. Those correlations are starting to get more positive when we talked about it back then, but I think now that's fully on. Like, why do you think bond markets have held up so well, given the fact that the equity market has rallied so much? Is it really just pricing in that yield curve control, or is risk reverse parity here and basically buying stocks and bonds is just a bet on the credibility of the U.S. and the central banking system, and selling both as vice versa?
Yeah, Nick, I think that's a very high level question, and I won't claim to have the answer. I really just can't, but I can comment on, the like you said, the dollar seems to keep benefiting from this flight to quality or flight to safety whenever there's issues, right? So I still feel like we're winning the sort of we're winning the reverse beauty contest, where, as you say, there's no need for FX volatility if every central bank is on the same plan. And I think going into the coronavirus, there were like literally 24 central banks that were leaning toward easing on the planet, which was basically all of them, except for, I guess there was maybe one or two outliers. But that's no matter what. That just speaks to the fact that they only have a hammer to combat any kind of a problem, whether it's a broken nail or a fire, right? So that they're just pivoting to anything with monetary easing. And I think that people just realize that their only outlet to get on that train of interest rates spiraling towards zero is staying in the bond market and having faith in that view. Like Raoul Pal at Real Vision has been, he was a really good beacon in the bond market. He was a bond bull from the whole move as rates collapsed. And, he had it right in that everybody's going to need dollars. And when the world starts coming apart, there's an even bigger rush for dollars to deleverage. And then there's a rush to U.S. assets. So, he's kind of got this right so far where, the dollar isn't coming apart. There's a shortage of dollars and the bond market is just bid as bollocks to the highs. And it just seems to refuse to back off. So, I'm not really sure, like I said, how to exactly answer your question, but it's interesting that the U.S. keeps getting this benefit of the flight to quality. And it's almost, to me, I look at it as a divider in the wealth gap. In the US, we have a sort of divider of the wealth gap internationally because of the strength of the dollar, that it keeps putting all this pressure on all of these other countries, especially emerging market countries. So it's amazing how that dynamic is playing off on a couple of different levels globally, where the rich are getting richer and the poor are getting poorer.
Yeah, I mean, I think the bond market is probably the most confusing chart right now, at least the TLT. I have really no trade on it. I could make an argument either way. I mean, my personal bias is probably to the downside for price, upside for yield, but there's not enough conclusive evidence to put on that trade at this point.
Yeah, it's hard. It's hard, man. I try to when the macro markets get violent, I rather just let the bond market be my beacon rather than take it on in any way. It's just too much of a take no prisoners trading vehicle that I just feel like the risk for me getting run over in the bond market is too high. So I just kind of watch it on my odometer and see what it tells me.
Yeah, and then more on a lighter note, read in your note about this concept of the financial justice warriors, and you see these people on FinTwit, which I'm starting to get more involved with because I thought it might be help people get awareness of what I'm doing here at Davos. But I try not to like just spill all of my guts on the internet like some of these people do. And the question is that why do you think there is the emergence of this group, and is the financial justice warrior like crying uncle really the catalyst for markets to normalize in terms of fundamentals?
Well, put it this way. I think that the financial justice warrior has always been around. He's just got an enormous platform, a 40-foot tall stage, a stack of Marshall speakers behind him, and, a place to voice his opinion now. right? Like all of these financial justice conversations were always taking place. They were just taking place inside IB chat rooms in between brokers and traders and this and that. And during the financial crisis and during the, dot-com bubble coming apart, all of that was just done on the QT. And now, Twitter has brought it to the public forum. So, and it reminds me now that I forgot to mention that my number one resource for measuring market sentiment is Twitter, right? It's like you can hear the financial justice warriors on cue. Oh my God, we had 8 million unemployment claims and the S&P went up 2.5% and they're livid,
I don't
right?
know. Financial Twitter seems pretty bullish to me now. They're trying to join Doctor Strangelove on this whole thing.
I don't know. I don't know if they pivoted to bullish yet, but I think that there are a couple of people have at least started to realize that getting rinsed at the lows was unpleasant and that they're not likely to try that again.
Yeah. Sorry, continue your thoughts. I didn't mean to interrupt.
No, you didn't interrupt anything, Nick. You didn't interrupt.
But yeah, I mean, to be honest, I was probably a financial justice warrior until at least 2017, maybe
Yep.
even later. Because I always thought there is this idea of economic gravity and it should play out. The thing is that I'm starting to learn by studying more economic history is that you can hold things a lot longer. Like I keep going back to the USSR as my example because they are the perfect example of unsustainability. That was
Yeah.
the most that was the most messed up in terms of like inefficient economic system on a large scale to ever happen in the history of the world, and it lasted for 75 years.
Yeah. Yep. Totally amazing. Totally amazing.
Yeah, and because of that, now I have that as a context to think, yeah, like a lot of crazy things can last a long time. China's housing market's another example. It's gone up. It hasn't. I don't think had more than a 10% drawdown in a major city in China for 30 years. Yeah, it's now the highest PE of like price to income in the world at 30x.
Yeah. Yeah, it's insane, and it's what the market will bear, right? It's what the market will bear. The market decides that they need to chase that. That's what's going to happen. You know, that's just how it goes. One of the things that just changes, look at how the market chases utility stocks now, because they're a high yielding animal in the equity market. So like utility stocks are like the new semiconductors, when cyclicals get going, it's like, oh, forget it. Utility stocks are bid only every day for months at a time. And you're like, they're buying an electric company. How could an electric company have increased its multiple at this level? And the answer is because everybody's just paying up for whatever piece of dividend that they can get their hands on. So it's just interesting to see how, the carrots get dangled in different places when people are chasing yield around,
So what is the role of an active manager or somebody who's trying to trade a market based on having some sort of long-term vision when really the best way to make money is just listening to a 21-year-old pick a random ticker that they've heard of?
Wait a minute, that's a good way to make money? What are you talking about?
Like if I just bought the stuff that like my siblings and cousins in college thought was cool versus actually doing any sort of fundamental analysis, I would be 10 times wealthier than I am right now.
That's true. Now, you know what I've adapted is I want to put it this way, man. If you want to be in the stock market, if you want to be an economist and you want to predict things about policy and politics and economies, then you can be an economist. That job is out there. They have salaries. There are places for them. There is a home for an economist at all different kinds of firms. If you want to be a trader, throw that shit out the window and play the game that is being played by the rules that are being laid out for you, right? Like when you talk about financial justice warriors, the thing that I get absolutely nauseous over is the people that are like coming back at you and saying, like, in addition to the financial justice, they'll come back to you on Twitter and say, oh yeah, how did your bond short work out, right? And they'll say something like that in May when my bond short was in 2018. Right.
Yeah.
So it's just my point that like these guys are like thinking that somebody is dying on the hill of their view over there when I'm over here making money 15 times over since that trade, right? Like so
Yeah.
like if you want to sit here and make money, then play the video game with a smile, stack your quarters up and say that I want to survive here on this machine and forget about the freaking market having to agree with your beautiful thoughts.
That's why I don't publish my specific trades outside of my paying clients for that very
Yeah.
reason.
Totally fair, right? Like totally fair. I get it. But my thing is I just abandoned sitting in front of the computer with an ulcer and took up sitting in front of the computer with a big popcorn and a Dr. Pepper and a smile and saying, oh, look, it's telling me it's going this way. If I believe it, I make money. If I want to be a big shot and fade it, I lose money. So let me just play the game to win and get a high score.
Yeah, and speaking of that, if you don't have a fundamental anchoring, how do you size positions to manage risk correctly? Because
Oh, so true, man. So true. See, and that like sizing positions to manage risk correctly is something that you just hit on the very heart of something, the transformation that I just went through during this waterfall. And I think I'll share it because it's interesting. Like, I had a lot of chips on the table and a lot of different bets on, and I was long Bitcoin, and Bitcoin I'm using as one example as something that I sort of didn't think reacted the way that I thought should have reacted to that slide in the markets, right? I was like, why is Bitcoin getting crushed with all this risk taking? I would have thought that Bitcoin would have been rallying. So I puked out of my Bitcoin position and I took it off my radar because, like you said, in the equity market, there are opportunities to upsize your positions right now based on sentiment and technicals like I've almost never seen before in my life of trading markets. Like maybe 2015, 16 was like a time that I remember that things were really, really cooking and you were in the dead heart of a trend. And those trades that were working during the trend were the trades that you could be like, oh yeah, I'm going to triple my bet on this one because this has been working for 6 months and it's going to work for the next 6, right? So when you notice those pockets in the market, that's where I'm focusing all of my attention, and I've got all of my noise cancellation blinders on, and I'm just letting last sale tell me what to do. So it's like I've abandoned like the Bitcoin idea, and I'm just focusing on U.S. equities because when you get the moves of like commodities driving in a direction and equities driving with them, like we're seeing, for example, in oil off the bottom now. I mean, those are great opportunities to upsize your bets when the retail public is looking at oil and saying, "Oh, I'm going to pull up to the pump next week, and they're going to give me money to pull away with a full tank." It's like, no, that's an actual reason to get long all the oil stocks because sentiment is gone wild to the downside. So, just an experience to share.
thanks. Brian, do you have any final questions or comments before we go?
I don't have anything else to add to this conversation other than I'm very thankful that Tony, you were able to come on the show and join us for a Saturday morning. And I'm looking forward to see how wrong we all were in the next
Yeah,
6 months, or right.
no
Yeah.
doubt.
Yeah, I mean, I still have a don't have a bearish bias, but I have to. I'm just a lot more tempered with it because I'm not gonna get myself railroaded like I did in 2019. I learned that mistake.
Dude, Nick, I mean, if there's one, I mean, take. If I was going to make a recommendation, I would say change your verbiage of should be somehow. You know what I mean? S and
Yeah,
P should be here. It should be there. I don't know. Maybe just pivot it to a different language and say, I have a valuation of this. Maybe it's different than should be because should be, kind of intimates that the market should eventually get there when the reality is it may never. You know,
yeah.
so that kind of thing. And if it does never, then your view will never be in line. So if you change the verbiage, you give your chance to stay in the game.
All right. Yeah, if you want to follow Tony, go to tgmacro.com. He writes the Morning Navigator. It's a good report on what's going on in terms of like market sentiment and technical perspectives, which is a lot different from what I do with Davos Platinum Research. I incorporate some of that with my chart books. It's not. I'm a lot more fundamental base, and thank you for joining us on Nothing Exempt. And if you'd like to contact us, you can email us at nick or brian at nothingexempt.com, or join our subreddit, or follow us on Twitter at Nothing Exempt, or you can follow me at Nicholas Pardini.
Awesome. Nick, thanks so much for having me, man. It was really, really great to be here.
Hey, you're welcome.